So let's talk about our second weekly option strategy, and that's our income strategy. And let's look at an actual trade. We'll look at the evolution of an actual trade that has the potential to collect a 207% cash payout. So let's take a look at that. We call our weekly income strategy the Guaranteed Automatic Now income program, and that can provide safe, dependable income that puts cash payments in your pocket every week without taking big risks. So I think GAIN will give you a totally different perspective on income investing. And the GAIN payouts that we receive each week when we sell a covered call, the premium we receive for selling a call option is in cash, and that cash is deposited directly into your brokerage account. So once that money hits your account, it's yours to keep, and you get to keep the cash payment for the sale of the call option no matter what the underlying stock does. So, so these automatic cash payments, we call this automatic income now, and what we do is we establish weekly covered calls, and then the cash payments for the sale of the call option for the covered call, we get cash payments that are credited to our brokerage account for the sale of the option premium. So you can set up this weekly covered call strategy in a regular brokerage account, and here's an example of a one-week payout that we received. And this particular week, we collected $16,978 in cash payouts, and we sold call options on these ETFs, and this was the actual cash payment that was credited to our brokerage account. And again, we get to keep those cash payments regardless of what happens to the price movement of the underlying ETF or stock. And unlike normal stock dividends that pay a 3 to 4% return over the course of a year, we can regularly collect 100% or more cash payout annually. And as I mentioned, in our GAIN book, we list over the trades over the past 10 years, and we collected over $9.9 million in actual cash payouts using the GAIN strategy. And that averages out to about $82,000 a month in cash payouts from the GAIN strategy. And also, this is approved by the IRS to trade in IRA accounts, and we trade these covered calls in our IRA account. And another advantage of this strategy is you can start out small. You need about a $3,500 trading account to start collecting these weekly cash payouts, and that'll get you started. So it's a low-risk income strategy, and it actually incurs less risk than owning stocks or ETFs, and I'll show you an example of that in a minute. And another advantage is the weekly covered calls. You can also profit in bear markets, and in our GAIN book, we list all the cash payouts received over the last 10 years, and we showed in 2008 that we collected $598,000 in cash payouts. And what we were doing is we were selling covered calls on inverse ETFs that profit when the stock market is going down. So these covered calls work just as well in bear markets by using inverse ETFs that profit when stocks are going down. So the GAIN cash payout strategy is a covered call. It generates cash income from selling call option premiums on your ETFs or stocks. And it's produced consistent returns during volatile and non-trending types of markets also. Most investors aren't familiar with the concept of selling option premium to generate cash payouts. And it's a very simple but lucrative income strategy. The cash payout strategy is also known as a buy right or a covered call. So when you sell a call option, cash equal to the option price or premium is credited to your brokerage account. One option covers 100 shares of an ETF or stock. So if you sell a call option with a 2-point premium, you'll receive a $200 cash payout in your account before commission. For example, we own 1,000 shares of the small cap ETF symbol TNA, and we sell 10 call options weekly to generate income. So let's take a look at what this looks like here. And our brokerage account transaction report shows that on August 26th, we sold 10 of the TNA 75 strike call options at 3.20 points. So this option sale generated $3,200 in cash payments. So that's 10 times $320 equals a $3,200 cash payment, and after commission, that came out to $3,184.20. So we had a $15 commission, collected $3,200 in cash, and after the commission, it was $3,184. And this shows the actual cash going into our brokerage account right here. So the sale of the 10 TNA 75 strike calls was covered by the ownership of 1,000 shares of TNA. So we owned 1,000 shares, and then we can each week we can sell 10 TNA call options. And unlike a traditional stock dividend, you don't have to own the stock on the dividend date to receive the quarterly dividend. You don't have to wait a year to receive a 3 or 4% annual dividend. We've been receiving up to a 3% cash payout every week selling these call options on ETFs and stocks that we own. And the strategy is easy to implement. You buy 100 shares of a stock or ETF and then sell to open one call option to initiate a covered call trade. Let's look at an example of a covered call trade we implemented. This is for the energy ETF symbol ERX, and on August 26th, we bought 100 shares of ERX at $31.47. So the cost to purchase the 100 shares was $3,155 after commission. So we bought 100 shares of the energy ETF on August 26th, and then that same day we sold to open the ERX September 2nd weekly call, 31 strike call option at 1.10 points. So August 26th, we sold to open the September 2nd 31 strike call at 110. So this September 2nd, this was a weekly option, and it expired 1 week later. So we collected a $110 premium for that 1 week trade. So one call option covers 100 shares of the ETF. This call option expired 1 week later on September 2nd, and it's known as a weekly option. And then these weekly options expire every Friday, so there's 52 weekly option expirations over the course of 1 year. Now, when we sold the September 2nd 31 strike call at 110, $110 was credited to our brokerage account. $110 in cash was credited to our brokerage account minus the $877 commission. So there was $101 cash credit to our account for selling this 110-point call option. So there's two possible outcomes for this weekly ERX covered call trade at option expiration on September 2nd. If the ERX ETF is trading above 31, which is the strike price of the call option we sold, then the ETF will be called and the 100 shares of ERX in your account will be sold at 31. So this happens automatically at option expiration. And if the ETF is called, then we realize the full profit potential for the trade. The other possibility is if the ERX ETF is trading below 31, then the shares of the ETF will not be sold, and we get to keep the 100 shares of the ETF in our account. And if the price of the ETF drops over that 1 week period, any loss on the price drop in the ETF will be reduced by the $110 in cash we received for the sale of the call option. So we like to keep the shares of the ETF or stocks in our trading account so that we can collect a cash payout every week. So what we do each week is we roll over the expiring call option at expiration, and that can help prevent being called out. So what we do is each Friday, we simply close out the expiring call option, and then we sell a new call option for the following week. So we like to just keep the shares of the ETF or stock in our account, and we can do that by rolling over. So in this example, we'd roll over by closing out the September 2nd call option, the 31 strike call option. So we would buy to close the September 2nd 31 strike call option. We close that out, and then we sell to open the call that expires 1 week later. So here's an example. We closed out the September 2nd call, and then we sold to open the September 9th call, which expired 1 week later, and we got a $165 premium on this, $165. After commission, that was $156 in cash went into our account for selling the 30 strike call that expired 1 week later. So we roll these over, and we get to keep the 100 shares of ERX in our account. And then on September 9th, we would close out the September 9th option, and then we'd sell to open the September 16th option. And in this case, we sold to open the September 16th 32 strike call. So we just keep rolling these over each week and collecting the premiums, and this allows us to collect up to 52 premiums per year with weekly options. Now, if you forget to roll over the expiring option and it gets called, your stock gets called, it's not a big deal. You just simply buy 100 shares of ETF and then sell to open a weekly call option to reestablish your covered call. So if you forget to close it out, the ETF will be called or the stock will be called, and then you can just reestablish it by buying 100 shares and selling a weekly call option. So let's look at these. These are rollovers for the ERX. We rolled over to the September 9th and then the September 16th. So these are just the examples of the actual trades. We rolled over to the September 23rd weekly option, September 30th, October 7th, October 14th. So we just kept rolling this over, October 21st, October 28th, November 4th, November 11th. So we kept rolling that over, and over that 10-week period, we collected $1,264 in cash payout. So that averages out to about $126 a week in cash payouts. And over the course of a year, if we get a similar premium each week, then we have the potential to collect $6,552 in cash payouts over the course of the year. And remember, our initial investment was $3,156. So you can see you have the potential to collect $65.52 in cash payouts on your original cost of $31.56. So that would represent a 207% cash payout on your original $3,156 investment to purchase the 100 shares of the ERX ETF. So you can see over the course of a year you can collect a lot of premium for this $3,156 initial investment. So if you can collect a 207% cash payout, a lot can go wrong and you can still be a successful trader. The ETF could decline sharply and you'd still profit. You could have bad timing when you enter the trade and still profit. And you can profit if the ETF goes up, down, or is flat. So, and you can also profit during volatile price moves in the stock market, and you can quickly compound your returns by reinvesting your cash income. So, you know, that's $6,500 in cash income. If you keep rolling that over, you can buy another 100 shares of the ETF and compound your returns by trading additional covered calls.